So in this short video, we're going to be going over a couple of the cost concepts, which will become clear in a second. I want to start with an example. Suppose I offer to sell you my drug, which I call Shiladril. It is a patented drug which has 1 year left on the patent, and so there's 1 year left of profitability. And you're trying to decide whether to buy it, and I'm trying to decide whether to sell it. Suppose that there are the following cost considerations. One is employee salaries, which amount to $50,000 a year. Additionally, suppose that I'm operating this company without actually taking any salary, but if I had been working in another job in the market, I would have been earning $75,000 a year. So instead of earning that, I'm actually working for this company, which is my company, and I'm taking all the profits for myself. Suppose further that there's a third consideration, which are depreciation costs. Suppose that a number of years ago, I had purchased a highly specialized piece of machinery that wouldn't be used by any other drug manufacturer or any manufacturer at all. So it's worthless to anyone else, but it was something that at least initially I was using in the production process for my drugs. And I found something better now, but still depreciating it. And we'll assume that revenues are $200,000. So those are the sort of costs or cost type things and revenues. So my first question for you is, what are the accounting costs? What costs would appear in the financial report? So think about that for a moment. You can pause the video, and when you're ready, you can unpause it. Okay, so I'm still going to hold off on actually answering this question. I want to ask you one other question first, and then I'm going to sort of work my way back towards those two questions. So the second question is, how much should the company be worth to me, the owner? That is, what is the minimum amount I should be willing to sell the company for? Okay. Okay, so now let me talk a little bit about the difference between accounting costs and economic costs, which is really what this example is supposed to show. Okay, so accounting costs are explicit costs, that is money that actually goes out the door, plus depreciation costs or depreciation expenses. Okay, those are the only things that count for accounting costs. My foregone salary has nothing to do with the costs that would appear in a financial report or in some sort of an accounting summary. So obviously the employee salaries count. The reason depreciation is included is as follows. So suppose that you were to buy a car. We're not talking about a company now, we're talking about you. You buy a car, let's say you buy it with cash. When you buy that car, your cash assets have gone down, right? You'll have less money in your bank account, less invested in stocks, and other things like that. But you're not actually poorer by the price of the car, because you may not have as much cash on hand, but now you have something else that is valuable. You have a car, something that you could resell and recoup much of what you spent on it. Okay, so it would be misleading to suggest that your net worth has gone down. And the same idea applies to companies. If you were to assume that when they buy some highly specialized piece of machinery that they suddenly have less assets, that's not really true. They have less cash assets, but they have something else that has some value, maybe to other companies, at least to the company that bought it. So why do we depreciate it? Well, like a car, most machinery has a limited useful life. Right? It breaks down over time. Eventually it stops working. And so each year, as it gets closer to that sort of final period when it's no longer of any use, it's going to become a little bit less valuable because there's less of a lifespan left. Think about your car. When you buy a car, each year it becomes a little bit less valuable. The amount that you could sell it to someone else for goes down a little bit each year. Okay, and that decline in value is accounted for in these depreciation expenses. Now, usually, I think what they do is they would split the expense of the machinery evenly across the years that it's expected to work. So, it might be $200,000 up front. You might expect it to work for 20 years. So the depreciation expense would be $10,000 per year. Now, this depreciation expense still is, appears in the accounting report, even if that piece of machinery that was purchased is highly specialized and cannot be sold to someone else. And it still appears even if I'm no longer using that piece of machinery myself, if it's just sort of sitting on the factory floor, but is completely unused. It just has some tarp over it, and everyone just kind of walks by it and makes jokes about it. Even if that's the case, it still needs to appear in the accounting report. Okay, so now let's contrast that with economic costs. Economic costs are the explicit costs plus implicit costs, which you might think of as opportunity costs. So, for example, the employee salaries would be something that count toward the economic costs, as would the market price of the owner's labor. Right? So by working for this company, I am giving up the $75,000 that I could have earned working elsewhere. Okay, so this would suggest that the true cost to me of running this company is $50,000 plus the money which I'm giving up. The depreciation expenses would not be considered economic costs in this example because I assume that this piece of machinery has no value in the open market. No one else will pay anything for it, so by sort of keeping this piece of machinery on my factory floor, I'm not actually giving up any sort of resale value. Okay, so what are the accounting costs? Well, the accounting costs were the $50,000 of employee salary plus the $10,000 of depreciation expenses, or $60,000 in total. And then the second question is, what should the company be worth to the owner? Okay, and to think about that, we have to think about what the revenues are and then what the economic costs are. The economic costs, recall, are equal to the $50,000 plus the $75,000 that I'm giving up by not working elsewhere. So the economic costs are $125,000. And so by earning $200,000 and the economic costs are $125,000, then I would be willing to sell this company for $75,000. Another way to think of it is I made $150,000 by running this company, or I would if I ran it another year. If I sell the company to you for $75,000 and then I spend that year working somewhere else earning $75,000, then I've earned that same amount overall over that year, $150,000. The quote that I have here is from an article. It says that President Bush, this is the second President Bush, has offered several reasons for staying the course in Iraq. One of them is the almost 2,000 Americans who have already died in the war. We owe them something, the president said on August 22nd. We will finish the task that they gave their lives for. So what is the president saying? He's saying because these soldiers have lost their lives in the fighting that we've already gone through, we have to stick it out and make sure that we win this war. This is a prime example of the sunk cost fallacy. As hard as it is to hear about these lost lives, those lives are lost no matter what. No matter what decision we make at this point going forward, those lives are lost. They're it's water under the bridge. And so because our actions now don't change those losses should not be factored into our current decisions. Rather, we should be making a decision that leads to the best sort of outcome looking forward. Okay? We should weigh the cost of continuing to fight in the war against the benefits that we expect by continuing to fight in the war. And if those benefits exceed the cost, then we should go forward. Otherwise, we should not. The fact that we've already incurred some losses that cannot be recouped, that is irrelevant from this decision. And I have a number of different examples that you might be able to relate to. The first one is stock transactions. People are very reluctant to sell stocks that they've lost money on. Okay? Ignoring tax considerations, whether you've lost or made money on a stock should not impact your decision of whether to sell it. Your decision whether to sell it should just be focused on forward-looking considerations. So is the stock going to go up? By how much do I expect it to go up versus if it goes down, how much do I expect it to go down? Those are the things that should influence your decision of whether to sell a stock. What has happened so far, whether you've made or lost money on it, is not really relevant for whether you should sell or buy more of this stock now. What other examples do I have? Oh, this is one of my favorites. Finishing a meal that you already paid for. Suppose you go to a really fancy restaurant and you've committed to basically paying for the meal. You can't just walk out of there. We assume you can't dine and dash. So you walk in, you've ordered this meal, it's $100 a plate, you brought your date there, she also ordered a meal of $100 and you're going to, pay for him or her. So it's $200 and you sit down, you start eating this meal and it is the most disgusting thing you've ever had. You want to throw up. Like you really want to throw up. But you decide that you're going to keep on eating it because this plate, after all, costs $100. I argue that that doesn't actually make any sense. You've already paid the money or committed to paying the money no matter what. That expense of the meal is a sunk cost. It's already, for all intents and purposes, gone. Okay? Whether you should finish that meal should just depend on the benefits and I don't really costs. Like, do you want to keep on eating it? Maybe you want to just throw it out and go to Chipotle and get a meal that you like, even though it doesn't cost as much. Right? But often people will sort of stuff feed themselves, so force themselves to finish a meal, even if it's not that great, or even if they're really full, assuming they can't take it home, just because they want to get their value. But that doesn't actually make any sense. And then the last example, well, actually I have two more examples. One is relationships. Sometimes people stay in relationships too long because they think I've already spent all this time in it, but that time spent is a sunk cost. And the last one is poker. I don't know how many people still play poker, but when I was in college, I played poker some. Often you're sort of betting on a hand. You'll get more cards, at various stages, and so more information will come out. Sometimes people, if they've already put a lot of money into the pot, they will want to stick out a hand. They'll keep on putting more money in. But if you're not very likely to win that hand, if you realize that at some point, then it doesn't make any sense to keep on putting more money into the hand. You're better off if you just fold. Okay? What should you really think about? You should think about how much money is in the pot. Doesn't matter how much money you put in the pot. It's how much is there for you to still win. How many players are left in the game, which impacts your chances of winning the hand, and what cards are out there. That's what should matter, not how much money you've already put into this hand. But even semi-professional poker players will make this mistake. Okay, so there's a lot of examples there. Okay, so lastly, why do we want to distinguish between accounting costs and economic costs? Well, if you were trying to evaluate some company, what you really want to know is the economic cost, but usually that's not available. The best thing you could do is go into the financial reports and get the accounting costs. But if you assume that the accounting costs are exactly the same as the economic costs, then you might make some poor decisions. Okay, so you really want to understand the differences between the accounting costs and the economic costs so you can properly, or at least make some adjustments to try and properly evaluate the value of this company.